Carmen Mail here, the mortgage guy who does baseball events, heading into Seattle on one of the ferries from Bremerton. And I thought I'd take a few minutes. I'm going to be on the road for the next several weeks doing my opportunity with the Play campaign with Major League Baseball, promoting a lifetime of activity among youth. And I thought, you know, my day job, as many of you know, is to do mortgage origination. And I thought this would be a cool thing to be able to do mortgage moments from the road. I don't know, the mortgage industry can be kind of dry. Talking about loans can be kind of boring. So I thought, okay, let's provide a little bit of a backdrop to some of the things that you or your clients may be interested in as they're thinking about mortgage origination. So I'm just going to take a few minutes, talk about an overview. And as you can see, I'm coming across right now from Bremerton, across through the Puget Sound, heading into Seattle, which you'll see in the background, passing Mount Rainier. And I thought, let's talk a little bit about how to make your mortgage origination experience a smooth one. Hey, look, I love the ferry. I like boats, but I definitely want a smooth ride. So I thought, let's talk a minute. Let's use the fact that I'm going on this ferry, and it is a beautiful day here in the Seattle area, probably in the 70s. Picture perfect day, smooth ride. We just saw a few pod of orca as we passed. It's almost a bit surreal. So anyhow, hey Janelle, good to see you from Vero Beach, and Kelly, thanks so much for watching for a moment. If you guys can hear me okay, give me a thumbs up or a wow face so I know that you can tune in with me here. So as we go across here, there's basically four things. What's going to keep your ride smooth in originating a mortgage as you think about loan origination? Because you hear all the horror stories today, and it can be a real pain sometimes. But the reality is there is a way to help your journey be a smoother journey so that you can get from the port, like I'm going from Bremerton to Seattle, to make sure that the destination is where you want to end up. So anyhow, let's talk for a minute. There's going to be basically four elements that you, as you go into the mortgage origination process, are going to want to be aware of. They're simple. Let me give you a broad brush. We'll drill them down for a moment. This video isn't to drill down to every detail, but to give you an overview, especially if you're either haven't bought a home in a few years or haven't financed one, or if you're a first-time home buyer. Four elements. They're typically income, your assets, your credit, and collateral. So we're pulling in here to Seattle in just a few moments. Let me just take about 5 minutes and talk about those, give you an overview, and then we can go into more detail in other mortgage moments from the road. So here's Carmen Mail heading across to Seattle from Bremerton on a ferry through Puget Sound. First element, income. The question is, what income do you bring to the equation if you're wanting to do a mortgage? What's your job history? Are you a W-2 or self-employed borrower? Both are fine. Generally, we look for a 2-year job history. If you're self-employed, we want to see a 2-year job history well, especially if you're a self-employed, like either if you have a S corporation, limited partnership, sole proprietorship, whatever. We'll work on the details. Let's look at the history. We want to see, underwriters always ask 2 key questions. What about continuation? And what about, is it going to last? In other words, the question they want to know is, will your income continue? And is there a history that suggests that what you're doing today is something you're going to do in the future? Underwriters are responsible for one big key question, and that is, will this individual or will this couple pay back the loan? That's what they want to know. And oftentimes I ask myself, or I might ask a client, say, look, the simple scenario is this. Would you loan yourself money for a home loan? If you were an underwriter, is there anything in the background there that might suggest or cause concerns to an underwriter? You just want to be forthcoming about those, because there's so many different options today. Don't assume that you are not able to get a home loan. There are options. You need to talk to a loan officer. Of course, I would be privileged to serve you, or another qualified loan officer in that field. So the first, income. What's your history? How long have you been doing it? Are you W-2, self-employed? All key questions, but all have opportunity, I assure you. By the way, some of you may think, gosh, I've just graduated from school and now I'm doing my work, so I have to wait 2 years? The answer is no. If you've gotten a degree in a particular field and are now exercising that degree in a particular profession, employment, we can generally do a loan with 30 days of pay stubs. Isn't that something? So basically an underwriter, again, looking for continuance, history, something to assure them that you're serious about the job you're doing. Education becomes a part of it. So Carmen Mayel here, taking a mortgage moment from the road as I'm in Seattle, or actually heading into Seattle, as you can see. We're coming through the Puget Sound, coming at Lefting Port at Bremerton, and now heading into Seattle. Beautiful day here. So again, 4 key elements in mortgage origination: income, assets, credit, collateral. We just spoke about income. Let's talk now about collateral, or pardon me, let's talk about assets. What monies are you going to bring? What are the assets you have to bring for down payment and closing costs? Generally, you can do as low as a 3% down payment. 3%, that's not a lot. But don't forget that there are also closing costs. What are closing costs? Generally, I would suggest that in addition to down payment, I would figure another 3 to 3.5% for closing costs. Now that's a good equation in the $200,000, $300,000, $400,000 purchase range. Once you start going up the ladder a bit, there are certain fixed closing costs that don't adjust substantially, and so that percentage may become lower. But in general, for many, it's a nice rough guide to keep in mind that if I'm thinking about putting down a minimum down payment of 3 or 3.5%, that depends on the particular loan program. There are many options out there that you'll need an additional 3 to 3.5% for down payment or for closing costs. Let me summarize quickly. Closing costs are really 4 things. Our fee as a lender, every fee has a lender. Processing fee, underwriting fee, whatever they want to call it, every lender has a fee. Government fees and taxes, title expense fees, and what we call prepaids and insurance. So those 4 cover what we call closing costs. And as I said, I would factor another 3 to 3.5% for those closing costs. By the way, if you want to go ahead and read up on that a little bit, I have written a couple of articles on that for the first-time home buyer. Just search my name, C. Carmen Mayel, and Google it, first-time home buyer, and you'll find those articles. Okay, so we've talked about income. We're going to now talk about assets. What about credit? Oh, everybody wants to know, what is my credit score? Before you assume that you can't buy a home because of credit issues you've had in the past, if that's the case, talk to a qualified loan officer. Let that person pull and review your credit for you. Sometimes the credit scores that you may pull from some of the great credit providers are not the same scores that we're going to be provided. So be careful of that and allow someone that's qualified to evaluate your credit relative to mortgage origination. Have the opportunity to serve you. Let them do their job, and then they'll be able to give you a little guidance on that. There are government loans, FHA, VA, USDA, that are designed to help borrowers that may be credit score challenged, and therefore allow them still the opportunity to purchase or finance a home purchase. So we have income, assets, collateral, credit. The 4th is collateral. Not something you have to worry about at this point if you're just beginning to look for a home loan or think about that process. But collateral is a valuation of the property as determined by an appraisal. So as you get into a contract, you're going to have obviously one of the things that the loan officer is going to do, and the company for which he works or she works is going to be able to take an appraisal. That appraisal forms the foundation of your loan. Remember that in the mortgage industry, your loan is always going to be based on the contract price or the appraised value, whichever is less. The appraised value the loan is always going to be based on the contract price or the appraised value, whichever is less. So keep that in mind, and then obviously if you're in a contract, let's say an appraisal comes in a bit lower, you have options. And we can talk about that another time, but don't ever feel that you're locked into a situation if your appraisal doesn't come in where the contract price is. So what are the 4 elements again? What is the basis as far as if you're wanting to originate a loan, if you're wanting to finance your home, what do you need to look at? What's the broad picture? How do I ensure that my ride from Bremerton, oh, and the captain's talking to us now. Oh, I guess we're getting ready to come into Seattle. So I'll wrap it up and simply say 4 things. What are they?
Drivers and passengers.
Income, assets, credit, and collateral. 4 elements that will ensure that your ride and the mortgage process is a smooth one. And to help you make sure that you get to your destination as I am arriving at mine right now. Hey, thanks for watching. Pat, thanks for tuning in. And I trust your day is going as well as mine is right down here in the Northwest Territory. Bye-bye.